October 19, 1987. That date remains seared into the collective financial consciousness, often attributed to mass panic, but our Black Monday crash analysis reveals a far more complex and insidious truth. Today, we dissect the actual mechanisms that triggered the most devastating single-day market collapse in history, debunking the myth of irrational investor behavior as the sole culprit. The question isn't just what happened that day. It's about identifying the invisible architectural flaws that turned a normal market correction into an unprecedented catastrophe. Was it truly human emotion that broke the system, or was something far more mechanical at play? Before the chaos, the market stood on a foundation of seemingly robust growth, with the Dow Jones Industrial Average climbing over 40% in the preceding 9 months. Yet beneath this surface prosperity, fundamental economic indicators signaled emerging vulnerabilities. Trade deficit put pressure on the dollar. This economic backdrop created a market primed for volatility, a complex system already under stress. 6% decline in a single trading session. $3 trillion in today's currency vaporized in a matter of hours. Trading volume surged to an unprecedented 604 million shares on the New York Stock Exchange, nearly double the previous record. The velocity of this value destruction was without precedent, prompting a global ripple effect across international markets. To truly understand the who, we must first examine the how, and the how involves two revolutionary, yet poorly understood, financial instruments: program trading and portfolio insurance. Program trading, in its essence, is the automated execution of large block trades using computer algorithms, often arbitrage strategies designed to profit from small price discrepancies between related assets like stocks and their corresponding futures contracts. These systems operate with speed and scale impossible for human traders. Simultaneously, portfolio insurance emerged as a sophisticated hedging strategy designed to protect institutional investors from market downturns. It achieved this by programming computers to automatically sell stock index futures as the market fell, thereby creating synthetic put options. The mathematical elegance of portfolio insurance was undeniable. Its systemic risk was not. These financial innovations, designed for efficiency and risk mitigation, ironically became the fatal mechanism of the crash. The core flaw lay in their collective, emergent behavior when activated simultaneously under market stress. As the market began to dip on Friday, October 16th, and continued its slide into Monday, portfolio insurance programs began to execute their pre-programmed sell orders. They offloaded futures contracts, primarily in the S&P 500 index futures market, which exerted significant downward pressure. This pressure in the futures market, however, immediately impacted the underlying equities market due to program trading. Arbitrageurs, identifying the growing price disparity between the falling futures and the relatively higher underlying stocks, would sell the stocks and buy the futures to profit from the convergence. This created a dangerous feedback loop. Portfolio insurance selling futures pushed prices down, which triggered program trading to sell actual stocks, which further pushed down equity prices, which then triggered more portfolio insurance selling. The market structure itself was critically unprepared for this self-reinforcing dynamic. Crucially, there was a stark fragmentation between the equity market, regulated by the Securities and Exchange Commission, and the futures market, overseen by the Commodity Futures Trading Commission. This regulatory divide meant that different margin requirements and trading rules applied to instruments that were, in practice, inextricably linked. There were no circuit breakers in place to halt trading and allow for a cooling-off period, meaning the automated selling cascade could continue unimpeded. The sheer volume of orders overwhelmed the specialists on the NYSE floor, who were traditionally responsible for maintaining orderly markets by buying when others sold. Their capital and capacity were simply insufficient to absorb the tsunami of sell orders. Information dissemination also played a critical role in accelerating the downfall. The NYSE's ticker system, responsible for reporting real-time trade prices, became severely delayed, lagging by over an hour at the peak of the panic. This meant that traders were making decisions based on outdated data, creating immense uncertainty and exacerbating the breakdown of market efficiency. Without accurate pricing information, rational decision-making became impossible, further contributing to the liquidity crisis. Buyers disappeared, unsure of actual prices or the true value of assets. This created a market where selling was the only viable action, even for those without program triggers. The true boardroom turning point, was not a single isolated decision by one corporation, but rather the collective, systemic miscalculation made by the financial industry and its regulators regarding the integration and impact of these new technologies. The decision was to allow these powerful, self-executing algorithms to scale without comprehensive stress testing or an integrated understanding of their potential for systemic risk. There was no overarching boardroom coordinating a unified market response. Only fragmented entities operating under individual mandates, often unaware of the aggregate effect of their strategies. The regulatory framework, built for a more analog trading environment, failed to adapt to the digital velocity of the 1980s. This oversight, or rather the absence of foresight, allowed a series of individual rational decisions to implement portfolio insurance or program trading, to culminate in a collectively irrational outcome. Consider the events of the preceding Friday, October 16, 1987. The Dow had already dropped 108 points, a significant move at the time, following a similar decline the previous Wednesday. These prior dips served as initial triggers for some portfolio insurance models. Over the weekend, political rhetoric intensified regarding a pending tax bill, increasing market anxiety. This pre-existing volatility, coupled with the systemic vulnerabilities, set the stage for Monday's collapse. When the market opened on October 19th, a small initial dip, perhaps triggered by weekend news or residual selling pressure, was enough to activate further rounds of programmed selling from portfolio insurers. The velocity of this initial decline pushed more models into their sell thresholds, creating a feedback loop that rapidly amplified. The market wasn't just reacting to news or individual decisions. It was reacting to its own internal mechanisms. Futures prices plummeted first, pulling down equity prices through arbitrage, which then triggered more futures selling, and so on. At one point, futures contracts were trading at a significant discount to their underlying stock baskets, an unsustainable disconnect that highlighted the extreme disequilibrium. The lack of liquidity became a critical amplifier. When there are no buyers willing to absorb the sell orders, prices can only go one way, down, dramatically. The post-mortem conclusion is clear. Black Monday was not primarily a crash of human panic, but a crash of algorithmic acceleration and systemic architectural failure. The true culprit was the unwitting combination of innovative financial products, program trading, and portfolio insurance, unleashed into a market structure unprepared for their collective power. These were powerful tools designed to manage risk, yet their aggregated, uncoordinated application created a new systemic risk profile that no one fully understood until it was too late. 6% plunge. The myth of human irrationality as the primary driver serves to simplify a complex, multifaceted systemic failure. The data unequivocally points to a breakdown in market architecture, exacerbated by new technologies. Black Monday forced a painful reckoning, leading to critical reforms such as the implementation of circuit breakers, cross-market coordination, and enhanced regulatory oversight. It was a brutal lesson in emergent behavior, demonstrating how rational individual actions, when aggregated and accelerated by technology within a vulnerable system, can produce catastrophic collective outcomes. The market did not just fall. It was pushed by its own internal logic, a logic born from the very innovations designed to make it more efficient. Understanding this mechanization of crisis is paramount for anyone navigating today's increasingly complex, algorithm-driven financial landscape. If you want to understand how similar algorithmic vulnerabilities, particularly in high-frequency trading, almost brought down markets again in 2010 with the flash crash, click on this next video to continue your forensic analysis of market mechanics.